In our last video, we talked about how you could get paid dividend income every month without having to invest in a monthly paying dividend stock. If you haven't yet checked out that video, then definitely check that out after the conclusion of this one. But today we are less focused on when we're going to get paid a dividend and more focused on dividend growth. After all, dividend growth puts the power of compounding into overdrive. A quality company, strong management team, strong free cash flows, plus dividend growth is a great equation to building long-term sustainable wealth. So today we're going to look at 3 of the best dividend growth stocks that you could buy or potentially buy in the future for your portfolio. All 3 of these companies are quality companies. All 3 of these companies have great management teams, and all 3 of these companies have strong dividend growth. If you're excited to discuss 3 dividend growth stalwarts, then do me a huge favor and click that like button down below as I put these videos out for free, and that helps me immensely. Also, consider subscribing to the channel so you are notified anytime we drop a new video, and you'll be notified anytime we go live. Every Thursday at 7 p.m., I host the Dividend Power Hour, which gives you a great opportunity to ask me questions live. So with that being said, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me take a quick moment to thank today's video sponsor, which is Moomoo. Moomoo has a ton of great tools for investors of all levels, and they're right there at your fingertips. Some of those tools include the earnings calendar, which I use a ton during the peak of earnings season. And they also have a heat map, which shows the performance by sector, something I look at on a daily basis. Aside from all of these great tools, right now they have a very special promotion for viewers of my channel as they are giving away free stocks. If you sign up using my link down in the description below, deposit just $100, you will get 5 free stocks and $100 cash reward. And as a special bonus right now, when you deposit that $100, you will also get an extra free share of AI stock. However, if you go even further and deposit $1,000, you will receive an additional 10 free stocks. And lastly, if you deposit $5,000, you will get 1 full share of either Tesla or Google stock, which means in totality, you could receive up to 17 free stocks. Make sure you use the link down in the description below. All right, now back to our video where we're going to talk about 3 of the best dividend growth stocks for your portfolio over the long term. Beginning with dividend growth stock number 1, which is the Home Depot, stock ticker HD. The Home Depot, as you are probably aware, is the largest home improvement retailer in the US today. The company has a market cap of $302 billion, and over the past 12 months, the shares are up 10%. However, year to date, they have dropped down by 5%. Home Depot is often tied to the real estate market, but they are also strong enough to excel even when the real estate market is cooling. The real estate market has been a bit of a roller coaster of late, as you have high interest rates combined with a shortage in inventory. This makes it especially hard for first-time home buyers. And combined with that, you have homeowners all over the US that are sitting on loads of equity, and they're also sitting locked in at a sub 3% interest rate. So some of them are asking the question, why would we move? So what that does is that leaves homeowners in their current homes looking to do more one-off projects, which benefits the likes of the Home Depot. Home Depot is a company that has generated huge amounts of free cash flow over the years, especially during those pandemic years. Looking here, you can see that in 2010, HD had $4.3 billion in free cash flow. Fast forward to 2023, and Home Depot generated $11.5 billion, which is more in line with where the company was prior to the pandemic, when free cash flow jumped to over $16 billion. Looking here at the company's latest cash flow statement, you could see that Home Depot paid dividends of $7.79 billion during the full 12-month period. If you divide that by the company's free cash flow, that gives you the free cash flow payout ratio, which is a good metric to determine the stability of a company's dividend. The company's free cash flow dividend payout ratio is 68%, which is actually quite high for Home Depot, but not all that high nonetheless. The year prior, the free cash flow dividend payout ratio was 50%. Free cash flow levels are expected to rebound after cooling down after a major boom during the pandemic, which will naturally bring down that free cash flow payout ratio. In terms of the dividend, Home Depot currently pays an annual dividend of $8.36 per share, which equates to a nearly 3% dividend yield. Looking at dividend growth over the past 5 years, Home Depot has a 5-year dividend growth rate of 15.2%, which is very solid, and the board has increased the dividend for 14 consecutive years. So as we could see, the dividend growth is great, as is free cash flow. So where does this sit with valuation? After the company's recent earnings release, which management said they now expect a decline in sales and net income for the year, analysts have brought down their 2023 estimates. Analysts are looking for EPS of $15 flat during the year, which equates to an earnings multiple of 20 times compared to a 10-year average of 22 times. So you're getting a slight discount here, but I'm looking for a better entry point with Home Depot. As such, I've been utilizing cash-secured puts to find a lower entry point. Dividend growth stock number 2 is Broadcom, stock ticker AVGO. Broadcom is a semiconductor company, which is one of the latest to take part in the AI craze, getting a huge boost in the latest month with their stock price. The company currently has a market cap of $358 billion. Over the past 12 months, shares are up a staggering 75%. But year to date, they are up nearly 60%. And close that gap even further. In the past month alone, shares of Broadcom are up 35%. Luckily, I own the stock, but this is just another example of a company that has ran too far, too fast, even though they have a ton of great long-term prospects. Broadcom is a semiconductor company that specializes in various hardware components, such as processors and chips, for various areas of technology from Wi-Fi and data to data centers, cybersecurity, and yes, of course, AI. Here are some of the customers that Broadcom has: Apple, Alphabet, Meta, Microsoft, all major companies and all major players within the AI space. CEO Hock Tan updated investors during the company's recent earnings release and discussed the topic of AI, noting that AI will account for 15% of semiconductor revenues this fiscal year, up 10% from the prior year. Moving out 1 year, though, Mr. Tan believes AI will account for 25% of semiconductor revenues, which is some major growth, and it means AI will now account for nearly 20% of the company's total revenues. Broadcom is another company that generates huge amounts of free cash flow. Looking here, you could see that the company generated $4.4 billion in free cash flow in the most recent quarter, which was up 5.3% year over year. Here's a look at the company's free cash flow by year from 2010 through 2022, showing that in 2010, the company generated $433 million compared to the $16.3 billion they generated in 2022 for the full year. And that number will continue to climb with AI beginning to take off. Through the first half of the year, Broadcom has already generated $8.3 billion in free cash flow, and they've paid out dividends of $3.84 billion, which equates to a free cash flow payout ratio of 46%, making the dividend both plenty safe and having plenty of room for continued growth moving forward. Speaking of that dividend, the stock currently yields a dividend of 2.3%, and they have a 5-year dividend growth rate of 21%. The board has increased the dividend for 12 consecutive years. But going back to that dividend growth, 21% dividend growth, a 5-year dividend growth rate, that is some insane numbers. And they had some huge increases throughout that period. But do I expect that moving forward? No, probably not. I expect something more in the range of 15%, especially as AI continues to generate more free cash flow for the company moving forward. Looking here at valuation, you could see that spike in share price of late, which has made shares much more expensive. Analysts are looking for EPS of roughly $42 this fiscal year, which equates to a 2023 earnings multiple of 20.6 times. Over the past 10 years, for comparable purposes, shares have traded at a multiple closer to 15 times, which makes the current valuation appear overvalued. However, there's a huge opportunity for this company within the AI segment, and I expect the EPS to increase as much as I expect free cash flow to increase as we move forward throughout the years. The third dividend growth stock on our list is Bank of America, stock ticker BAC. Bank of America is the second largest U.S. bank in terms of total assets, trailing only JP Morgan, which has total assets of $3.7 trillion. Bank of America, as of the latest quarter, has total assets of $3.2 trillion. Bank of America currently has a market cap of $233 billion. Over the past 12 months, the shares are down 8%, and year to date, they are down 13%. The banking sector has been a bit of a roller coaster of late as we saw that mini financial crisis, but it's actually benefited the likes of Bank of America as they have seen a huge inflow of deposits and a ton of new accounts that have been created. In a few weeks, we'll get the latest update from the banking sector as they usually kick off the latest earnings season. And we'll also see how the higher interest rates have impacted the company, as this is one of the benefits as interest rates go up. They see a benefit with what's called net interest income, which is really the difference between the amount of income they can gain from giving out loans compared to how much interest they have to pay out for the likes of a savings account. As interest rates go higher, the bank is able to charge more for their loans, and that impacts net interest income, which increased nearly $3 billion in the most recent quarter, which was a 25% increase year over year. This has flowed through to the bottom line as net income reached $8.2 billion in the most recent quarter. Loan dollars continue to increase, but at the same time, so does the bank's credit provisions, which is really thought of as an emergency fund if and when the economy falls into a potential recession, which means some clients will be unable to repay their outstanding loans. Given the recession we talk about on the horizon, Bank of America shares look very cheap, as a lot of that is already priced into the stock. Analysts are looking for 2023 EPS of $3.43 per share, which equates to an earnings multiple of just 8.5 times, which is incredibly cheap. To give you an idea of how cheap this is, at the trough of 2009, during that recession, the great financial crisis, shares of Bank of America dipped to a multiple of 7.9 times, not all that far away from where things stand right now. Over the past 5 years, shares have traded closer to 12 times, and over the past decade, closer to 14 times. Looking at the dividend, Bank of America currently yields a dividend of 3.1%, which is a dividend they have hiked for the past 9 years. And in terms of dividend growth, Bank of America has a 5-year dividend growth rate of 13%, making it yet another great option for those of you looking for strong dividend growth. So there we have it, folks. 3 of the best dividend growth stocks for you to look at for your portfolio. Home Depot has been one of my favorites for a long time. A great management team, and they're able to generate huge amounts of free cash flow, often tied to the real estate sector, and shares are looking a little cheap right here. Broadcom, on the other hand, they saw the AI bump of late as shares have skyrocketed. So I'm waiting a little bit on shares to look to add to my position there. And lastly, Bank of America, the second largest U.S. bank in terms of assets, giving you over 12% dividend growth rate, and a company that is trading just extremely cheap looking at these levels. Down in the comments section below, let me know, which of these 3 dividend growth stocks do you own in your portfolio, and which dividend growth stock are you looking to add to your portfolio? If you haven't done so yet, make sure you smash that like button down below. Subscribe to the channel, and we'll see you in the next video. Take care.